Hi everybody, it's Alex Dinham here from Jathan Solutions Throughput Academy, and in this video we're going to look at how people commonly answer the P&Q puzzle. We're going to do this in a slightly unusual way because we're going to start by looking at the two most common wrong answers, and after we've done that we'll then look at the right answer, which you may find something of a surprise. Okay, so let's begin by looking at the most common wrong answer first. As I explain this, I'm going to use a particular way of calculating the solution which you should pay attention to. If you understand this, it will stand you in good stead as you learn about throughput accounting. On the slide there, you can see in the top row, P&Q products are heading up a column each, and the first row down on the left hand side you can see the sales price. P sells for £90 per unit, remember to convert it into whatever currency you're using, and Q sells for £100 per unit. The raw material cost of 1 unit of P is £45. You'll remember from the product flow that the raw material 1 is £20 per unit, raw material 2 is £20 per unit also, and the purchase part is £5 per unit, which gives us a total of £45 raw material cost for product P. For product Q, the raw material cost is raw material 2 at £20 again, raw material 3 also at £20, giving us a raw material cost total of £40. Now, if we subtract the raw material from the selling price, we get something which in the theory of constraints world we call throughput. That's the formula for calculating throughput. Throughput equals sales minus raw material. It's the difference between the selling price and the raw material cost, and it's the value that we create from taking an input, processing it, and turning it into something more valuable that a customer wants to buy from us at a higher price. There's no labour or direct costs in that calculation, it's just the difference between what we pay to suppliers and what we sell to our customers. I'll talk about that in more detail later on, because that's not quite the whole story, but it's sufficient for us to understand now. Okay, now we can see the throughput of product P is 90 minus 45, which equals £45. The throughput of product Q is 100 minus 40, which equals £60. The next thing a lot of people do is say to themselves, well, if that's the throughput per unit, I can calculate the total throughput by multiplying that by the market demand for both products and summing the two subtotals together to get the total amount of throughput generated during the week. So for product P, £45 of throughput per unit, market demand of 100 equals £4,500 of throughput in total from product P. For product Q, multiply £60 of throughput per unit by the market demand of 50 units and you get £3,000 in throughput generated by product Q. Then what people do is add the two throughput subtotals together, so 4,500 plus 3,000, which equals £7,500 of throughput generated in total for the week from satisfying the market demand for both products. And in order to calculate the net profit from there, we simply have to subtract the operating expense from the total throughput generated, which remember is £6,000 of OE that covers everything except for raw material costs. So 7,500 of throughput minus 6,000 of OE equals £1,500 of net profit for the week. And the answer is, of course, completely wrong. Okay, so where exactly did we go wrong? Well, the mistake that many people make is to assume that the plant has enough capacity to manufacture all of the market demand without actually checking whether this is true or not. So let's check that assumption now and see if we can make everything within a week. In the table, you can see the time required to manufacture the different products on each machine or work center. If you look at the left-hand column, you can see the green, blue, red and yellow machines, and at the top of the table you can see the products P and Q. We know the market demand for product P is 100 units and 50 units for product Q, and we can calculate the load that this places on each of the work centers by multiplying the processing time per unit by the number of units required by the customers. So if we look along the green machines row, we can see that each unit of product P requires 15 minutes of processing time per unit. 15 multiplied by 100 is 1500, and that is the amount of minutes required to produce that number of units of product P. Product Q, on the other hand, requires 10 minutes of processing time per unit, and demand is there for 50 units. So 10 multiplied by 50 is 500, creating a combined total load on the green machine of 2000 minutes during the week. Now we have in total 2,400 minutes in the week. That's 5 days, 8 hours per day, and of course 60 minutes per hour. So, if the load on the green machine equates to 2,000 minutes or 83% of the available capacity, we can safely say that it is able to produce all of the units that the market demands. But what about the blue machine? Blue requires 15 minutes per unit to produce one product, P, and that means 1500 minutes in total to manufacture all 100 of the parts demanded by the market. Product Q requires 30 minutes of blue's capacity per unit, and with demand for 50, this means an additional 1500 minutes are required. So in total, blue needs to do 3000 minutes of work, but we only have 2400 minutes available. As I mentioned in the briefing, the resourcing for the factory cannot be changed during the week, so we must face up to the fact that we cannot supply all of the market demand, and we need to make some choices about what demand we are going to satisfy. We have a bottleneck, otherwise known as a constraint. If we quickly whiz through the remaining two machines, the red and the yellow, we can see that both have plenty of capacity to meet the demand for product P and Q. Blue is the bottleneck. Blue constrains our ability to service all of the market demand. We are going to have to make some tough choices about how we use blue's time most effectively and exactly what product and how much we can supply to our customers this week. Okay, so we've established that the plant cannot satisfy all of the market demand. So the next question we need to answer is which products we will prioritise production of. Let's look again at the data. The selling price of product P is £90 per unit and £100 for product Q. So on that basis, it would be perfectly rational to prioritise production of product Q. But that's not the whole story. Raw material is also important, but we can see that the raw material cost of product Q is less than that of product P, being 40 for Q and 45 for P. So again, product Q comes out on top. This inevitably means that product Q is better than product P when we look at throughput too. A higher selling price combined with a lower raw material must produce a more attractive level of throughput per unit, and we can see here that product Q generates £60 of throughput per unit compared to product P's £45 per unit. Another factor that many people pay attention to is to look at the direct labour required to make each of the two products, and again product Q comes out on top. We can calculate the direct labour required by simply adding up the processing times for each step in the product routine. So, product P requires 5 minutes of green's time, 15 minutes of blue's time, and 15 minutes of red's time. There are two operations on red, one for 10 minutes on the left-hand side leg of the routine, and 5 minutes for the red process on the middle leg of the routine, plus a further 10 minutes of blue's time at the bottom of the middle leg of the routine. Add all of this to the 15 minutes required at the yellow resource at the top of the left leg, and it totals 60 minutes of direct labour to make 1 unit of product P. If we do the same calculation for the Q product, we have 15 minutes on blue in the middle leg, 5 minutes on red on the middle leg, 10 minutes on green on the right hand leg of the routine, another 15 minutes on blue on the right hand leg, and a further 5 minutes on yellow at the top of the routine, coming to a grand total of 50 minutes direct labour in all. So now we can see that product P also comes off worse when compared to product Q on direct labour. It requires 60 minutes of effort from the resources involved to generate 1 unit of product, whereas product Q only requires 50 minutes of direct labour. So even on this basis, product Q is the more attractive. So it's very clear from the data we should prefer to use the capacity available on the blue resource during the week to produce as many, if not all, of the demand for product Q. It has a higher selling price, lower raw material cost, higher throughput per unit, and requires less effort to produce. It's a no-brainer. So we produce as much of the demand for product Q as possible, and only then will we switch to produce product P, and only if we have time remaining. We can calculate the production schedule from the data given to us in the experiment. We know how much time is required on the blue machine to produce 1 unit of Q, 30 minutes. We know the total demand, 50 units, and if we multiply the two of them together, we get 1500 minutes of total time required to produce all of the demand for Q on the blue machine. We know we have 2,400 minutes available in the week, so subtracting the 1,500 minutes from 2,400 leaves us with 900 minutes in which we can produce as many of product P as we possibly can. Product P takes 15 minutes to produce 1 unit, so we can calculate the number of units we can produce by dividing 900 by 15, which equals 60 units of product P. And that gives us our production plan. We're going to produce all 50 units of product Q demanded by the market, and we will have enough time left over to produce 60 units of product P. So let's now see what this does to our financials. So to follow the process again, we know the selling price of product P and product Q are £90 and £100 respectively. We know the raw material costs are £45 and £40 respectively, and we therefore know that the throughput per unit for each is 45 for product P and £60 for product Q. If we multiply the throughput per unit by the volume produced, we can get the total throughput per product, and that comes to 2,700 for product P and another 3,000 from product Q. If you add those two amounts together, it comes to £5,700 in total throughput. We then have to subtract the £6,000 of operating costs from that amount. Remember the OE, yeah? And we end up with a rather disappointing net loss of £300 for the week. But you'll be relieved to hear that this is also completely wrong too. Okay, so let's try again. In the previous attempt, we followed the textbook approach. We went for the product that had the highest selling price, the lowest raw material cost, the highest throughput per unit, and the least direct labour required. This is exactly what the conventional cost accounting approach would advocate, but we made a loss at the end of the week, which is not good. So this time, let's be controversial. Instead of doing things by the book, let's rebel a little and do exactly the opposite of what we should be doing. Let's prioritise production of the product that has the lowest selling price, the highest raw material cost, the lowest throughput, and that requires the most direct labour. Exactly the wrong thing to do, but let's see what happens. So, just as we did on the previous attempt, we need to calculate how much market demand we can satisfy because, remember, the blue machine is still a bottleneck and can only produce so much of the demand from the market. So, as we know, each unit of P requires 15 minutes of blue's time to produce. The market demand is for 100 units, so multiply the two together and you get 1500 minutes of total production time required on blue to produce the market demand. If we subtract the 1500 from 2400 minutes available in the week, we are left with 900 minutes to produce as many of product Q as we possibly can. Each product Q takes 30 minutes of blue's time, so 900 divided by 30 equals 30, meaning we can produce 30 units of product Q in addition to the 100 units of product P that we've already produced, and that is our production plan. So let's see what that production plan does to our financials. If we multiply the £45 of throughput we get from each unit of product P, it gives us a total of 4,500 from producing all of the 100 unit demand for product P. And if we multiply the £60 of throughput we get from each unit of product Q sold by the 30 that we are planning to produce, we get a further £1,800 in throughput. So then we take those two throughputs and add them together, so 4,500 plus 1,800, and that gives us the total throughput generated during the week of £6,300. We then need to subtract the £6,000 of operating expense from the throughput, and we arrive at a net profit of the week of £300 exactly, which of course is the correct answer. But how can that possibly be the case? We manufactured all of the demand for the product with a higher selling price, lower raw material cost, the higher throughput, and the least direct labour, and we made a loss. Then we did exactly the opposite and prioritized the product which was worse on all of those dimensions, and we made a profit. How can that possibly be correct? Well, watch the next video and you'll find out why.